early has explained to us what exactly is the human resource based on the lens of the human resource. We have Hrithika Sathish Kumar, a marketing manager, explain to us how SVB's collapse has led to the Jenga puzzle collapsing and risking other banks in the US system.
Thank you, Shreya, for the lovely intro. That middle section was very unexpected, talking about the work culture. But just to give you guys a little bit more of context, I am the one that has created the PPT, so I'm doing all of the marketing here. And I'm very excited to talk a little bit and examine the aftermath of the SVB collapse, with a specific focus on the collapse of the First Republic Bank and Signature Bank. While the United States was busy implementing interest rate hikes in an effort to curb inflation, an unexpected event unfolded, the second largest bank failure in the US history. The Silicon Valley Bank, known for its support of startup financing and as very beautifully explained by my colleagues Rishi and Olita. I'm just going to sort of give you guys a refresher, which is why I'm touching on it a little bit now. But it experienced a significant decline in stock prices, plummeting by over 70% since February 10th, 2023. This decline prompted venture capitalists to withdraw their deposits, estimated at around $42 billion. Ultimately, this led to the closure of the bank, setting off a chain reaction among similar regional and mid-sized banks. First Republic Bank and Signature Bank were the first casualties of what we can aptly term as the curse of the SVB. Let's delve into the details of the Signature Bank's collapse. Based in New York, Signature Bank primarily catered to startups as well as middle market companies, law offices, real estate buyers, and cryptocurrency firms. In 2021, Signature Bank ranked as the 19th largest bank in the United States, boasting assets worth $110.36 billion dollars and $88.59 billion dollars in deposits by December 2022. It was recognized as the third largest commercial real estate bank. Notably, Signature Bank achieved a significant milestone by becoming the first FDIC-insured bank to develop a blockchain-based digital payments platform called Signet. However, it required a minimum account balance of $250,000, matching the maximum limit of the FDIC. The FDIC is the Federal Deposit Insurance Corporation, and I just wanted to give you guys the abbreviation of what it is because I'm going to be saying FDIC quite a bit throughout the rest of my speech. So let's now explore the main reasons behind the Signature Bank's failure. The bank entered cryptocurrency agency just before the FTX failure in 2022. By September 2022, almost a quarter of its deposits came from crypto clients, including Coinbase Global and Circle Internet Financial Limited. In December 2022, Signature Bank announced a reduction of $8 billion in crypto deposits, with an additional $1.3 billion lost from crypto platforms in the first 2 months of 2023. Before its collapse, Signature Bank faced an investigation by the Securities and Exchange Commission, also known as the SEC, regarding its cryptocurrency businesses, particularly concerning money laundering. This scrutiny significantly impacted its reputation. Additionally, a substantial portion of its deposits was uninsured, amounting to approximately $79.5 billion by December 2022. This is almost 90% of their deposits. This raised concerns among widespread bank runs and as depositors sought to withdraw their funds before potential losses occurred. Furthermore, the FDIC expressed concerns about Signature Bank's liquidity risk, attributing to its poor governance and risk management practices. The bank struggled to effectively manage its liquidity during the times of stress. While Signature Bank had sufficient reserves to meet regulatory requirements, only about 5% of its assets were held in cash, significantly lower than the industry average of 13%. The FDIC's report criticized the bank's slow response to their concerns and recommendations, attributing it to staffing shortages. Sorry. Currently, Signature Bank is under control of the FDIC and no longer operational. The FDIC is under US regulatory and other US regulatory bodies have assured that all deposits will be covered. Now let's turn our attention a little bit into First Republic Bank, another victim of the curse of SVB. This San Francisco-based bank targeted high net worth clients and offered wealth management services and support for startups. First Republic Bank had $205 billion in total assets and was listed as the 44th best bank in the US. At the time of publication on Forbes, First Republic Bank's collapse. First Republic Bank's collapse can be attributed to several key factors. Firstly, a significant portion of its deposits, over 67%, was uninsured. The bank reported uninsured deposits totaling $19.8 billion, excluding an additional $30 billion in uninsured deposits received from other banks in an attempt to sustain its operations. Many customers who withdrew their funds during the bank's last month likely exceeded the $250,000 threshold covered by the FDIC insurance. Additionally, the First Republic Bank faced challenges with liquidity, primarily relying on the net interest income from loans and investment securities. Many of its investments were in less liquid real estates, loans, and securities, which did not earn competitive interest rates. The bank also faced negative credit agency ratings, reflecting concerns about liquidity, funding, and profitability. These ratings were ignored or poorly managed by the risk management teams, contributing to the bank's collapse. Once a regional mid-sized bank experienced a bank run and near complete collapse, it raised doubts about the stability of similar banks. This loss of trust resulted in falling stock prices, and venture capitalists swiftly withdrew their deposits to safeguard their funds. First Republic Bank has announced plans to reduce its workforce by 25% and was recently acquired by JP Morgan Chase. Its common stock was delisted from the New York Stock Exchange on May 2nd. Some of the banks that contributed to the $30 billion in deposits have set aside approximately $100 million each. And in conclusion, the collapse of SVB had far-reaching consequences for banks like Signature Bank and First Republic Bank. Uninsured deposits emerged as the common theme in these collapses, highlighting the need for regulators and banks to be more vigilant. Notably, the collapse of SBB had a ripple effect not only on the First Republic Bank and Signature Bank, but impacting other banks such as PacWest Bancorp, Western Alliance, Zions Bancorp, and Charles Schwab, among others. It is imperative that lessons are learned from these events to prevent future financial crises. Thank you, everyone.